What's up, guys? Welcome back to the TNT Business Podcast. I'm your host, KT Temple, and I am here with my co-host. It may say Pamela Temple, but his name is actually Kent. Welcome to the show, man.
Yeah, it's a snow day, so I'm at home on her computer instead of in my office. So
Did it snow that bad over there?
no, it
No.
turned out a bunch of ice. We didn't get near the accumulation we were supposed to get. By the way, everybody knows now that we're pre-taping this because when it comes out, it probably won't be snowing.
Speak for yourself, man. I don't know how Jersey weather goes. There is so much freaking snow outside. This is the most snow I've ever seen in my lifetime, like just happening outside. And the efficiency of the tire store across the street from my house and removing snow. I've been just watching these guys like they've got it down, dude. You can tell when someone's from Jersey because they know how to get rid of some snow. I've seen. Oh, by the way, dude, snow truck, like the snowplow trucks, fly. They go so much faster than I thought they would down the street.
Well, they got a lot of snow to move. There's a lot of roads.
But I didn't expect them to go like 30 miles per hour, man.
To everyone listening, welcome to my new Yankee KT.
Flying, dude. These things are flying. But anyways, we got a great show planned for you guys today. Two topics that we're going to cover. We did two last week. We're going to do another two this week that are directly affecting home prices, debt for the general American. And that's what we're really focusing on in this like two-part series. First thing we're going to talk about is stopping Wall Street from competing with Main Street home buyers. And then second, we're going to talk about the credit card interest cap to 10% for 1 year. Before we get to that stuff, though, I do want to thank the Temple team. If you are looking to buy, sell, or invest in real estate, you can find us at thetempleteam.com. We are a real estate company based in Mooresville, Lake Norman area. However, we sell all the way from Hickory down to Fort Mill. And if you're looking outside of that area and you don't know who to talk to, we'll connect you with one of our trusted advisors all across the United States and even internationally. So again, if you're looking to buy, sell, or invest in real estate, you can find us at thetempleteam.com. So
I think we should tell everybody, just in case you missed last week and you want to go back and listen to it. Last week we talked about eliminating the capital gains tax on home sales and about the government, Fannie Mae, Freddie Mac, possibly buying back $200 billion or more in mortgages and what they'll do. So if you want to catch those two, definitely go back and listen to next week.
Yeah. So let's get started with stopping Wall Street from competing with Main Street home buyers. And this is something I'm certainly a fan of. I mean, it is wild the amount of inventory that some of these companies have racked up. It's already starting to bite them in the butt, from a lot of that investment. So I like the sound of this one. So we're going to take a deeper look into what it actually means.
It's a great sound bite.
Yeah, it is.
And Katie, when you go back and they started buying them, and we were coming out of a terrible housing market and everything, and I thought it was the Armageddon of what we do for a living. Like I do a lot of times, always overreact.
Well, I think that's important to say. In the real estate offices we're in, this was a huge deal. I mean, some people were very excited for it, but you saw the panic of what this could look like, 10 years later now where we are when this really started to really blast off, especially with the internet helping these companies kind of come in and do this kind of dealing. So the order directs federal agencies to ban large institutional investors from purchasing single-family homes. While the final decision of being refined by the Treasury, it generally targets entities owning 50 or more properties. A lot of people, if you're listening and you already know about this, you know the hilarious interview. There's these like little things that you see when people just don't understand, like a normal American. And I can't remember his name, but he was talking about, your mom and dad, they probably bought like 9, 10, 11 different properties for retirement. And where people are just like, what are you talking about?
What are you talking about?
Yeah. I don't know who you think owns 9 houses, but that's not who people are generally concerned about.
Yeah. So when Trump said this, he said that he wants to ban institutional investors from buying homes. His very first directive, KT, is to define what an institutional investor is, because there's actually 3 different definitions that I could find, and none of them were actually 50. The first one I found was 100 or more. Now at 100, and this is why KT we thought was Armageddon, because they were going to buy these properties. Right now, investors that own 100 or more own 2% of the homes in the country. Now, granted, I'd love to have 2% more homes on the market. That'd be great, but that is not that many. Another definition is 1,000 or more. Well, if you go 1,000 or more, they only own 1% of what's in there. A third definition was owning 1,000 or more homes in 3 distinct markets. So his very first thing is, okay, we are going to, within 30 days, we're going to define what an institutional investor is. That's a big deal.
Yeah, trying to figure out what that is.
Yeah. So then he wants to, after that, he goes, the second thing we're going to do is we're going to develop rules that's going to bar institutional investors from using government funds to buy anything.
Yeah.
Okay, great. But dude, they're not borrowing government funds anyway.
Yeah, that was the big thing that people forget about, that these are privately funded entities or publicly traded entities that are purchasing these homes. The amount of, just in your area, Dad, can you think of a private investor, just a sole person with 25 homes?
I know one person that has that many homes.
One person.
For years and years, and I don't want to call them a slumlord, but they are on the lower end of the scale.
Yeah.
Here's the thing about these institutional investors is typically they buy crappy homes.
Yeah.
They have to be fixed. The first-time home buyers can't buy because they don't have the money to put into them to do it. They're taking it. A lot of times they take homes off the market that aren't even it. KT, here's the thing is they've actually switched over. What I don't like now is I hate these neighborhoods that are built to rent.
That was one of my big questions is does that, I haven't seen anything included in all of this. Yeah.
The build to rent neighborhoods are not included in this.
Yeah.
Because right now, institutional investors are not buying. They're not buying the one-offs I'm not even close to the way they were.
Because it backfired, right? They were buying homes thinking that they could flip them at a profit or rent them out at a profit. As soon as interest rates took the change that they made,
they're not making the money they want.
Yeah. And it didn't seem like they really were making that much money. It didn't seem like every instance I saw, at least, there wasn't profitable. They were losing money on trying these kinds of systems.
Well, the ones that were losing money were they were trying to bomb and flip.
Yes.
Yeah. The holds they did okay on. But the thing is, they're not building right now. They're not buying right now. What they're buying is the whole build to rent neighborhoods, and those are being built to that. So it's again, this is almost a non-starter for me.
Here's the one thing that I'm excited about. That is around the rent portion of this, is that the Department of Justice and the FTC are directed to prioritize investigations into coordinated vacancy and pricing strategies, targeting algorithms and corporate tactics used to keep rents artificially high. And
they're doing that. There've already been some lawsuits. There's been some that have already been settled around artificially high rents.
Yeah, and that I think was the most hurtful part of all of this, is the raising of all the rents by all using. If you don't know about that, all these companies were using the same software to price the renting. So you were never shopping the market, right? You were picking location, but you were never shopping because they were all being priced around each other, keeping things very high. And so I am excited that they are looking into that more and trying to prevent that.
When you look at this, they're not going to be forced to sell, number one. They can keep all their inventory. And there's really, when you look at it, there's not a way for them to sell because all those have tenants in them anyway. That would be a nightmare. At the end of the day, if they're not forced to sell, this is really not going to help the current on-hand availability of homes to sell. Most experts agree that this is not going to help affordability. In fact, if this causes them to get out of the build for rent space, they could actually take it to where builders cut back. And if builders start cutting back, because a lot of the build to rent is subsidizing what they're doing on the build to own. Mm-hmm. With builders all of a sudden cut back, we could actually have the shortage of homes even go back the other direction instead of getting better, getting worse, and then affordability would get worse. There's just no guarantee that this is going to be. And don't get me wrong, it'd be great to me. I would love it if institutional investors didn't own any homes. Yes, but I just don't think this is going to help us in any big way in any kind of short term. And just over time, if they quit doing it, would be the best thing.
You glossed over it, but I do want to go back to what you said because I think it's very important. Is that we have a housing shortage in this country. We need more homes to be built, and builders. If you're a builder, are you incentivized to build a first-time home buyer home, or are you incentivized to build a $1.5 million home? You're incentivized to build the 1.5 one because there is no incentive. You're going to make more money the better home that you built. And right now, when you're thinking about what could help this housing shortage more than anything else, it's incentivizing the builders to build those starter homes. And so doing anything that stops that will bite you.
Yeah, I don't blame builders, KT. If I was a builder and I had the capacity to build 30 homes a year,
no,
and I could build 30 homes at 250, or I could build 30 homes at 450, my margin is probably be better on the 450. I'm going to take that.
Of course.
I don't blame them.
They're not incentivized to do the other one. There has to be some reason, and it might just be like just easing the way to build things. Right now, it's so challenging to build something. A lot of people are like, well, why is it more expensive? Well, if I'm going to get permitted and set up for a house, it costs the same amount for me to permit a $200,000 house than it does to do a $600,000 house. And that's just all upfront costs. And so there has to be a way to incentivize cheaper homes to be made for people to even want to do that.
Well, that's why I said I don't like the build to rent neighborhoods, because the ones they're building, those are the starter neighborhoods. Yeah. And a lot of those were planned originally to be built to own and kind of flipped over once new construction saw a little bit of downturn in their business. So yeah, I don't love those because typically that is the ones they're buying.
So the other part about this that I know that they are doing in New York, I haven't done a lot of research on it, so I really don't know. I've only heard negative feedback around it though, and that is these first look programs. And the order expands first look policies, giving individual homebuyers and nonprofit organizations a 30-day window to purchase foreclosed or government-held homes before they are offered to any investors. And that really slows things down and really unincentivizes people to do these kind of things because, oh, now I have to wait 30 days for someone to come in. Then we get to go under contract and then we can fall out. It just adds time and mucks up the situation. I know in New York, I think it's like 3 months or something crazy. Again, don't quote me on that, but it's a large amount of time that you have to do a first look to say, hey, any of these government approved people get to buy your home first, and then you can actually sell it.
Yeah.
So, anything else on that front?
I think we got that one.
All right. So in January 2026, the housing and financial sectors have been major focal points of the administration, specifically regarding a proposed to cap credit card interest rates at 10% for 1 year. The move is framed as a temporary relief measure to help Americans struggling with debt and to make it easier for families to save for home down payments. The 10% cap proposal. So the directive on January 9th, President Trump calls for a nationwide 10% cap on all credit card APRs, targeting the current average rates, which often exceed 20 to 30%.
All right, I'm gonna go ahead and tell you. I'm gonna tell you this up front, but I'm not gonna tell you why at the end. I'm completely against this, 100%. But I'll tell you why at the end.
So the deadline it was set for January 20th. That's obviously passed. This target date for banks to voluntarily comply. Though most major lenders have not yet adjusted their rates, citing a lack of legal mandate. The goal, the proponents argue the cap would save American consumers approximately $100 billion per year in interest payments, providing immediate breathing room for middle-class families. And the link to the housing is that the administration explicitly linked the cap to the housing market, stating that reducing high-interest debt is a primary barrier preventing millions of Americans from qualifying for a mortgage.
Okay. That's a little bit of a stretch, but all right. So can I give you
was 100% is a stretch. It is absolutely a stretch.
Here's why. If KT, if you're paying me $20 a week right now,
Mm-hmm.
and I said, okay, KT, you know what? Don't pay me $20 a week anymore. Only pay me $10 a week. Before we can assume what's going to happen, we got to decide what you're going to do with that extra $10. And right now, Americans have shown the tendency that they'll just go spend it on something else. Because 2 years ago, at the end of 2023, we had $900 billion in credit card debt, and then into 24 we had 1.1 trillion. Into 25 we were 1.3 trillion. So all we're doing is spending money. So let's be clear that that assumption, that's what they do with the money, is it. But KT, when I looked at it, the capping of the credit card interest rate at 10%, I can only come up with two pros on this. Yes, you said one. Estimate it would save $100 billion in fees. Oh, that's good. I mean, that's good in the consumer's pocket. Then that would create debt reduction if what I said just happens. If buying habits stay the same, though it won't. It'll create debt reduction if you actually do something with that money. That's it, man. I got no other positives to give you except that. I got a whole list of negatives. So I'm gonna start out. First off, if this is mandated, then banks are going to cut the credit lines because of risk. If you have an under 600 credit score, which is who actually needs credit, you're probably not going to get.
Yeah, not going to. They're not. They will cut back lending. Like it will freeze up money lines pretty fast.
It's going to hurt the people at the bottom the most. All right. So the second thing, they're going to increase the fees. Dude, they get again. You got two things they're doing. First off, the people that lend money have to make money. They have investors. Second, they have to manage risk. And that's how this works, because people are going to default. So this is why they charge rates, so that they can cover the people that default and everything. So fees are just going to go up. You got to know that. The third, there's going to be some serious market contraction. It's estimated that if this goes into effect, 85% of open credit card accounts right now would either be closed or they would reduce the amount that you can have. And KT, if you go back in the Great Recession that we had, that happened to me, man. I got notices in the mail that said your credit card amount used to be this and now it's this. They just started, cutting them down. So that's going to create less opportunities for people to spend money. There's going to be a whole shift to alternative lending, which I hate, because alternative lending is less regulated. There's higher cost to it. There's more predators. And
this is where you see the payday loan companies thrive in these kind of places. They will take advantage of, again, the people that you said under 600 credit scores that genuinely need this money. They are the ones going to be targeted.
It's the payday lending. It's also the things that I've never used and wouldn't know how, but this where you can order a taco now and pay for it later.
If you remember, my main recession indicator was buy now, pay later burrito. Buy now, pay later burrito is and hey, have you looked at those stats, by the way? How many people have defaulted on their burritos?
Well, the other thing that's going to go up, KT, is you're going to have more people getting money from my cousin Vinny.
Yeah.
Which is not good, because those rates are just terrible. That there's going to be a shift. There's the other one is, okay, if you're going to make the step to say, okay, if we take the credit card interest rate to 10% max, if we do that, that's going to create money in people's pocket to buy houses. Well, let me tell you what's more likely to happen. You're going to limit consumer spending. And by the way, I know that's kind of the goal of this, but if people quit spending money, the economy doesn't do real good.
And we are at a time right now, like, where we are teetering on these lines where that could be an immediate deal pretty quickly. Like if people's money dries up, the credit cards aren't able to use, and we have an immediate stop in consumer spending, that shock, I think, would hurt the economy pretty fast.
All right, KT.
What up?
Save the biggest one for last.
All right, what you got?
This is why I am vehemently opposed to this, because the first thing that's going to happen if they cap this is they're going to take away the perks, which means the cash back, which I don't do, but they're going to take away my travel points. They might limit my access to my airport lounges because they have to do it. They have to offset the lost interest income.
Yeah. I heard, by the way, I heard American Airlines is getting rid of theirs. Is there?
No. What they said was,
If this happens, they were going to do that?
What American Airlines said is, if you buy basic economy, you don't get the points anymore. You have to buy above basic economy to get it. All the airlines are going to that. But that's a different subject. But for me, the reason I said I'm against it is because I don't carry any balance on credit cards, so I don't have that. I do like my perks.
Yeah.
Not the real reason I'm against it. I think this is a bad idea all around. I don't think there's anything good about this because it's actually going to hurt the people that they think it's going to help. It's going to hurt the people that actually need decent, credit, not coming from my cousin Vinny or not coming from, payday loans, not coming from pawn shops. It's just, it doesn't seem what I would like to talk about, because right now, Katie, I've seen credit card rates almost to 30, like you said, and they're talking about 10. Man, is there not maybe a happier middle between 10 and 30? I mean, 10 to me, I once had a mortgage rate above 10. 10 does not seem that terrible in the big scheme of things. 30 seems outrageous. Is there not a number in there that might help people and not have such a negative impact on the lower income individuals and to the economy is my question. And again, I think I said this last week, that really, really smart people make all these decisions that we talk about. And KT and I just come in and play Monday morning quarterback.
I think it's the right question. I think the question is, do interest rates on credit cards need to be regulated better?
Yes,
because that's
a fair question, and I think the actual answer is yes.
Yeah, I don't think a flat cap is the answer to this. That seems like a very short-sighted political, like, hey, 1 year. It's the great Gary. Hang on one second. The great Gary Keller quote of, "You overestimate what you can do in a year and underestimate what you can do in 5." And I think these cap rates, if you're going to do anything, 5 years makes more sense. Maybe a higher cap, but I understand no cap at all. But the 1 year caps are not going to be the answer for any of the situations.
The weird thing is, KT, is the way I'm reading this is they actually could go in and put this in place for 1 year, but they can't make it permanent because it would take legislation to do that. It's weird. Well, how can you do it short term if you can't do it?
Well, I think the legal experts and bank CEOs have noted the president likely cannot enforce a cap through executive order alone. It would require congressional approval to amend the Truth in Lending Act. And so I think that is why. That is the answer there.
Man, we covered all 4 of them.
Yeah, we knocked it out. We did it before 4:00 too. We only have an hour marked out for this.
Everybody should listen.
Maybe we should start doing it now. Maybe we give you a week off every other week and just do an hour at a time.
Should we announce that the Fed met and they did not cut the Fed rate? Because that hasn't happened yet, but 98% of people say it did. So I'm going to say, hey, in case you haven't heard, that's what happened.
The biggest detriment to young women is credit card debt. The biggest detriment to young men right now is online sports gambling. And I'm scared that you might get into interest rate gambling. So, all right, guys. Well, thank you for listening. If you found this interesting, please share it with somebody and please leave us a review. It really does help us out a lot. We'll see you guys again next week with another episode. And thanks again to the Temple team. You can find us at thetempleteam.com. Whether you're looking to buy, sell, or invest in real estate, find us at thetempleteam.com. See you guys again next week.